you feel like you're on an island. You don't know that other people are doing this, and you think you have to be smart to figure this stuff out, when actually you have to be humble, right? You have to read the books, recognize what you don't know, ask the questions about what you don't know. And then when you learn those things, all of a sudden, it's like you can't close the door once it's been opened.
This is the Multifamily Journey Podcast, show 23.
You're listening to the Multifamily Journey Podcast. In this show, you'll hear industry experts share tips of success and failure from their real estate investing journeys. You'll get a transparent look behind the curtain while you learn to fulfill the lifestyle you want to live and achieve your wealth goals. Get ready for the journey to financial freedom through investing in multifamily real estate. Here's your host, Blake Dailey.
Hey, what's up, everybody? Welcome back to the Multifamily Journey Podcast. I'm your host, Blake Dailey, and excited as always to be delivering another show to you guys. Have a really cool guest today who I think hits a lot of the topics that when you're starting out that you want to hear or need to hear. And today the guest is Steve Libman, and this is somebody who's been in the game for a long time, 11 years now. He started out by flipping and was doing like 150 transactions a year at a really high volume, and raising millions of dollars for that flipping business. And then he made a pivot because he realized that that was a business, that was active income. And he wanted to, got into real estate to be passive and to be able to retire, spend time with his family. So he made the pivot to multifamily and used the same strategies that he was using to raise millions of dollars for the flipping business and raise money for the multifamily business. And then through a strategic partnership, got in the game, in the syndication game. And since then has just rolled that success into more, started managing and operating his own deals. And then through that kind of same process, like finding what he likes and doesn't like, went on to just do this fund to funds model, raising capital. So now that's what he's doing. That's where his focus is. And he's done a lot of deals like he was talking about in the episode here. So he's one of the managing partners of Integrity Holdings Group. They're based in New Jersey. And I love how their company's set up because not only do they provide really good returns for investors, but they invest a lot back of their own profits into charity. He actually talks about how a 7-year-old daughter is one of his investors, and she takes 10% of her earnings. Well, he probably does it for her, but takes 10% of those earnings as a tithe and gives back. So really a top-notch guy and a really good discussion today. So, and it's curious because it's the same thing that I did to get started on my 66 unit, was bringing the capital to a more experienced operator that had the deal. And now we each bring two important parts of the deal and able to do it together and get further together. He said in the show, if you want to go fast, go together. If you want to, I'm butchering the quote. If you want to go fast, go alone. If you want to go far, go together. So I really like that. And then another little update on the 8 unit. I got the number back from the contractor, the total bid amount. I haven't got the full bid, but it looks like the numbers are going to work. So that's really good. Now I just got to check the rest of the bid, make sure there's no red flags, or, make sure he's not buying the bid as we call it, bidding low to be able to increase the price on later. So wanted to get that before I went and got the money for it. And the reason I did that was when I'll probably raise in a debt position like a normal flip or burr. And when doing that, I wanted to have all my stuff together, have all my numbers and my analysis so that if, ask a question, I don't have to answer with, I don't know, or I'll get back to you. So that's why I like to do that. And now I got a couple of days left of due diligence to put this all together. So here we go. Yeah. And one thing I haven't mentioned in a while is if you have questions that you want answered on the podcast, head over to multifamilyjourney.com/podcast, where you can ask your questions and I'll see those. I'll be able to ask the guests those on the shows. So just another place to, if you have burning questions, get those answered, and allows me to continue to provide value that you guys want to hear, provide content that you guys want to hear. So yeah, head over to multifamilyjourney.com/podcast. And yeah. And like with that, let's get in the show. All right, Steve, welcome to the show, man. Good to have you here.
Thanks, Blake. Appreciate you having me on. Excited to chat about generational wealth, passive income, multifamily. I love this stuff.
Yeah, man. I love it. It's a beautiful Saturday morning to be talking about passive income. It always is.
That's right.
Yeah, man. Well, for those that don't know you yet, why don't you start out by giving people a little bit about your journey and how you got into real estate?
Yeah, I graduated from Boston University in 2004. I started working in Manhattan doing basically door-to-door sales for a payroll and tax filing company. Realized pretty quickly I wanted to work for myself. Didn't want to commute into New York. I live on the Jersey Shore right now, so commuting into Manhattan.
Is Snooki your neighbor?
Yeah. Oh man, let's delete this part of the show. No, so actually,
starting strong.
That is where I live. I live
guy.
over the bridge from where the Jersey Shore was filmed, and Jersey Shore, it was actually a great place. But now, no, it's a beautiful area. We love it. Commuting into the city took a lot of time. So learned, always knew that I wanted to be an entrepreneur of some form or fashion. Then I got my real estate license and started working for some family doing the retail residential stuff. I did that for a couple of years. I found some off-market deal flow and some on-market deal flow for some investors in the area that were flipping, and saw that they were making money and I was making commissions. So decided to start an investment firm with my partner, Travis. And we started wholesaling and then started flipping. We built our company to do about 150 transactions a year at the peak, and realized a couple things. One was it's not passive. It's very transactional. It's a great high paying job, but that's exactly what it is. It's a job, and it's very highly taxed. So everything is taxed in the flip world as ordinary income rates. So we started looking into how we could turn some of this active income into passive income, right? If we want to get into that investor bucket, how do we move our active income into there? So we started looking into some different ways to do that. We didn't know exactly, right? We started to just educate ourselves in that space and looked at some duplexes, triplexes, quads. Thought maybe we'll buy 100 single families because we were buying those things for pretty cheap. And then we just realized that the more people we spoke to that were in the space told us to really make sure that we went big up front. And it sounds a little counterintuitive to have your first deal be a large commercial project or a syndication where you're pulling money together with other people. But the economies of scale really make those deals make sense, right? That's why we're all looking for those 100, 150 unit deals. And there was a lot of management that went along with duplexes, triplexes, and quads. Very difficult to manage, right? You have one management company trying to deal with 100 different floors.
Different properties scattered
all over the place, right? So they're charging you 7, 8, 9, 10% versus 3%, right? 4%.
Yeah.
So everybody that we spoke to, we started getting around mentors. I mean, that's how we've grown every piece of this. Wholesales, flips, commercial, was get around people that are doing it, that are smarter than me, and tell me how they did it. And every single one of them said that the biggest headache was the 30 unit that they bought first, and the least problematic was the 250 unit that they just bought.
Yeah. And that came from just getting around the right kind of people. And I think if we just stopped right there and that's all people heard, that would be enough for them today to take action and get something from this episode. If you just get around the right people, find who are doing what you want to do and that are doing it well, and just ask them, talk to them. Those are the people you need to be around. That's really good.
I think the problem with being an entrepreneur is that you want to do everything yourself.
Yeah, it's almost too prideful sometimes. I've been there for sure.
100%. And you feel like you're on an island. You don't know that other people are doing this, and you think you have to be smart to figure this stuff out, when actually you have to be humble, right? You have to read the books, recognize what you don't know, ask the questions about what you don't know. And then when you learn those things, all of a sudden, it's like you can't close the door once it's been opened. Once it's been opened, you're like, oh, of course, the light bulb goes off, and this is how you create wealth. This is how you buy a multifamily. This is how you start a life insurance policy. Whatever it is that you're doing, get around the people that are doing it and have been doing it better than you have, and ask them some questions.
Yeah, that's really good. And I think what I've done in large part, I read this in a book early on. It's you don't have to do anything completely novel. Just model what works for others and do it really well. And some people say that oh, you're copying them, but no, it's just modeling their business and doing it your way. People have syndicated real estate for how long? Probably since real estate's existed. And
there's nothing new under the sun, right? So when you start to think about, copying somebody's model, or the smartest people I know do that, right? I mean, why wouldn't you do that? If you try to go a new way about it or invent a new, form or fashion, I mean, not to take anything away from the inventors of the world, but especially when it comes to real estate, you're not coming up with a new process or a new system of how to do real estate. Real estate is about acquisitions and management.
And that's why I love it, because it's proven, it's scalable, it's replicable. Yeah, that's a really good word for it. Yeah, that's good. So, I mean, for you starting out, getting from Wall Street off into Main Street, why was real estate so attractive? Like, why is that your asset of choice?
I think for a lot of reasons that we all are drawn to real estate. It's generally, we understand it, right? I understand that even my house is going to be valued at kind of what the neighborhood house is. It's less volatile, right? Historically, over the last 60 years, it has been consistently less volatile. I think it has a quarter of the downturns as the market does on average, and it has higher consistent returns. So that's why I liked real estate at first. And I can touch it and feel it, right? I mean, it's nice to log into your Fidelity account and see numbers moving on a page. But in a mutual fund, you're invested in hundreds of companies. How much do you know about the people in that company? How much do you know about what's happening in that company? And that's why we started the podcast Free from Wall Street as well, is like, people that are looking to escape volatility and get into something that they understand. I think real estate is easily digestible for the common person.
Yeah, I agree 100%. I'm glad you brought that up, because I wanted to get into that. Like the idea behind your podcast is Free from Wall Street, and you started there, and you've made the transition, and now you're helping others. And I think we were talking before the show, what is it, like 17 trillion, or I don't know how many trillions that's invested in Wall Street and mutual funds, making what you're saying, like 4.5% over the last.
Yeah, I mean, the Morningstar average, right? And you can look this up on Morningstar's website, and they kind of track all performance of stocks, bonds, and mutual funds. Over the last 30 years, it's been 4.5% via a mutual fund, which on its face is not terrible, right? What's not calculated in that 4.5% is the volatility of that, right? Like, I think when people understand that if you lose 20% of your portfolio and you had $100, now you have 80, but to get back to even, you don't make 20% and get back to even, right? You have to make 25% to get back to even. Yep. So there's a volatility distinction there that isn't talked about very much. And, you have to calculate that into your returns. So yeah, I mean, when you look at these mutual funds and stocks and bonds and things, you can crush it, right? But you can also get killed. And that's where our company's ethos was kind of born from. My dad passed away 7 years ago. He lost almost half of his accumulated wealth in the stock market during the last downturn, but then he didn't live long enough to ride the market back up like so many of us have been fortunate to do. It kind of made me start thinking about, okay, so volatility is a real thing. You can lose the money that you make, even if you're trying to secure it in relatively safe stocks, bonds, and mutual funds. I mean, my dad wasn't a risky guy, so he was in mostly blue chips and mutual funds and things like that should have been pretty stable. And then when you see that kind of a dip and you can't ride it back up, you start thinking, how can I insulate my family from that same destructive behavior? And that's why we start looking at real estate as well. And that's why we start looking to educate people that, look, real estate doesn't have to be the only thing you invest in, of course, right? But it should be a portion of your portfolio, because you can hedge your downside risk, right? And it can give you some consistency in your portfolio as well.
Yeah. I think everything you were just saying is really powerful, because if you look at it, like the reason why most people get into real estate is, to achieve financial freedom, get some passive income, to pursue other areas in their life that they have passions about. If they had the money and the financial resources to pursue, they would. So, you talk about making like 4.5% over 30 years, like that may not get you there. That may get you to a, semi-comfortable retirement. But if you really want I don't want to make it too big and like intangible. If you really want to like achieve your dreams and like what you actually set out to do, 4.5% is just probably not going to do it. And then you look at something like real estate, is less volatile, and you can make much higher returns. Like your fund is, or your deals are making 3 times that. So it's just
what I love about real estate. What I love about numbers in general is that it's predictable, right? So you can back out and say, if I retire at 55 and this is what I need to have in the bank to retire, you can back those numbers out and you figure out exactly what return you need, right? You don't have to guess, right? And I feel like, we've done a terrible job in this country of educating the youth on how to plan for retirement, right? You go to a financial planner and they just say, put 10% of your income into a mutual fund and don't look at it. And in 30 years, you'll be able to retire. Well, look, hope isn't a strategy. So I like to be able to calculate things. And that's what's great about numbers is you can actually say, I want to retire at 42 with this much money in the bank. This is how much I need to start with. This is how much I need to put away every year. And this is how fast it has to compound. And this is the rate of return I need. And you can figure that out, right? I think a lot of people, the thing that they miss is picking their number, right? Choose your number, figure out where you need to be, and then back into it. And then you know exactly how to get there. You can create your own roadmap when the big lie of Wall Street is that you're not smart enough to manage your own money and they're going to do a good job for you too. And you get to hope that you get to retire when you want.
Yeah, that's good. And I think another overlooked thing too is that in real estate, like in the stock market, like inflation over those 30 years is cutting down your returns. But in real estate, your rents are going up over time. You're paying your mortgage down over time. Your debt service, like your interest rate staying the same. So inflation dollars, you're actually paying less. So like real estate gets better over time, like more, it's inflation adjusted. So I really like that aspect of it too, long term. So let's talk about where you are now, like with in multifamily. Obviously, this is the Multifamily Journey Podcast, so want to get into that and with how you're syndicating. So, what is the syndication realm looked like in the previous years, and where are you at today with that?
Yeah, so when we got into this space, we knew that we didn't know enough to go and start doing our own deals. I mean, I think we started where a lot of people do, which is underwriting deals and submitting LOIs and trying to find brokers that would talk to us. Nobody cares that you flipped 1,000 houses. They want to know how many assets under management you have when they give you an off-market deal. And rightfully so, right? This is how these people feed their families. So they're not just going to float a deal by me and just see if I can execute. So after finding that out by making offers and talking to a lot of brokers and recognizing that our experience was going to be a big hurdle, we kind of pivoted. We knew that we could raise some capital because we had done so from the fix and flip world. We had investors that knew, liked, and trusted us already that would deploy capital with us. And we found a very strong operator. And our first deal was a $10.4 million ground up construction of 1,193 unit self-storage complex outside of Orlando. Cube Smart managed, huge project on 14 acres, over 130,000 rentable square feet.
That's a big deal for a first one.
It was a big deal. But we found a strong operator and we said, hey, let's partner. We're going to bring the money. You do the day-to-day operations and we're going to partner on this and we're going to learn from the inside. Right, we're going to understand the financing piece of it. We're going to understand the reporting aspect of it, the third-party management of it. And we've done 3 deals with that partner now, over 300,000 square feet of storage, all in and around the Orlando area, $10 million aggregate profit in those deals. So fantastic experience, great operator. We learned a ton. And then we have since purchased a 66 unit, an 84 unit, and 120 unit in Columbus and Dallas, Fort Worth area, respectively. And then this quarter, we are just about to embark on a $42 million acquisition in Daytona Beach, Florida, 384 units of multifamily.
I love it. So I've done a deal or two, like a deal or two. I love it.
Yeah, and that's all been in the last 24 months.
That's good, man. And I think that's what can happen when you build the, that skill set and get comfortable and really jump in with the right partners, right? You didn't have to do everything yourself for that first deal, which, got your feet wet and got the ball rolling for you guys. You found out where you could bring value, which was capital to this deal, and got to learn everything, and then allowed you to grow from there, which is, coincidentally the exact same thing I'm doing right now on my first syndication. So, I mean, it's great because with more experienced operators that are doing the day-to-day, then I bring capital and get to learn all that. And then it's a really good looking asset. So all the investors are going to be taken care of.
And it hedges the downside risk for the investor, right? I mean, even though I've flipped 1,000 houses, if I go out and buy an 84 unit complex, you're
going to have a learning curve.
Right. Yeah. Am I going to do right by the investor and their capital? So, so we were able to hedge the risk for the investor and for ourselves too, where we can make those partnerships take place. Look, I think you can go fast alone or far together. And a lot of people, many hands make light work in this business. You can really partner with some people that'll make your job easier. Conversely, you can partner with some folks that'll make your job harder. So choose wisely. But it's,
Yep.
there's good opportunity out there to not have to cut your teeth and know all things. I think the biggest struggle for a lot of people that get involved in this business is they think they need to know everything before they jump in. Right? It's insulate your weaknesses with your partnerships.
Yeah, that's good. I think anybody that's looking to get in the space needs to rewind that and just listen to that. That's really good. Moving on from that, we were talking before. You guys are making a little pivot now to you managed some deals, did that day-to-day operation, and now getting back to the sourcing sponsors rather than sourcing deals kind of thing, and then continuing to raise capital and bringing in your investors. So why that? I guess first of all, can you kind of explain that pivot a little bit more and why?
So like I just explained, we did the first couple of deals with a sponsor. We raised the capital, and he was managing the day-to-day, giving us reporting. And then getting into the owner operations side of things, right, which is where we've done a couple of deals. It has created a bottleneck in our business because you can't do everything, right? So you either need to do everything or you need to grow into being able to do everything or have a partner that's going to help you offset those, right? And I think, know thyself, right? You need to figure out what it is that your business is supposed to be, what you're really good at, and what you want to do. I think if you can accomplish all of those things, then the business life is going to be really beneficial for you. We've been in business for 11 years and we've done the stuff that we don't want to do, and we've done the stuff that we do want to do. And, you just have to be honest with yourself about what is it that I'm really trying to build here and to what end, right? What is the purpose? I think a lot of people get into this business because they want passive income. They want to build generational wealth. They want to spend more time with their families. They want to have financial freedom. Well, when you're an owner operator, you can grow into that over time, right? And, I think if you're the operator and you realize that, hey, I have this deal and I can operate it and I'm going to do a great job managing it. Oh, and now I have to go find the money and manage those investors. And that's a whole nother.
There's a lot to the game, I think, that people don't realize until they start doing it. Yeah. And get in deeper.
So if you try to do all of it, you create a bottleneck. I mean, our business is only 5 internal employees. So, what kind of business do we want to build? And how sustainable is this? And how many deals do we want to do? And all of those things, right? I mean, so we've been in this business, in this side of the business now for about 2 years. And it quickly becomes apparent what we want to do and what we don't. And for these deals, they're heavy lift repositions. We're going to leave a couple $1 million on the table and sell them currently so that we can go back to the partners that are fully operational day to day. They have more deal flow than they have capital. And we can just manage those relationships, manage those reports, and then manage our investors and bring capital into those. And for all intents and purposes, be a private equity fund.
Yeah. Yeah. And I think, some groups or people, partnerships, whatever, just have like natural skill sets. Like some groups are just really good at sourcing deals because they've been doing it, have all the relationships and have the track record of just doing really good deals. And then others have the track record of having great networks, being able to pull in a lot of money and capitalize deals, and knowing what you're good at or, where your skill set lies, or even if you haven't started, like, if you've been talking about real estate and you have people that are really interested, and you can go, get some money from them, pull together their money, and then you go start looking for the partnerships that are doing deals that need money. And then you get in, you get your investors a return. It's just finding what you're good at, finding where you can bring value. And I love that you guys found it by, first by starting and saying, hey, this is where we need to be because we don't know everything. Then you kind of did everything. And then through that process, through the action, found out what you really liked. And now you're, adjusting and really evolving as you guys go. So it's not jumping in and saying, hey, we're going to go do 334 units right now. It's, hey, we're going to start flipping some houses and we're pulling a bunch of money and partnering with a group. And then we're going to go do our own deals. And now we're, all right, we found what we're really good at and where our niche is and what we're just going to dominate at. That's really good.
Yeah, exactly.
And I think, for the people that are, maybe think that that's something they could do, bring capital to a deal. How is your your team finding the deals or finding the sponsors to partner with on deals?
There is no better asset class for building wealth than real estate. And in most instances, people don't have the time or energy to invest in it on their own. So how do you build wealth with real estate when you lack the time and energy? Leave that to the GrowthView Properties. The GrowthView team finds, negotiates, and manages multifamily assets for private investors. Their mission is to help investors secure the ultimate asset, which is time, all the while impacting the greater good with their endowment fund that fuels the mission of charitable organizations. Find out more by going to thegrowthview.com. That's view with a VUE.com. Put your money to work so you don't have to at thegrowthview.com.
I mean, it's just networking. You talk to enough people in the space that you let them know, hey, I'm able to bring some funds, or I'd like to bring some funds and add some value to you. And there's plenty of deals out there. There's plenty of people that need either money or deals. So, and then you got to find the people that like and trust. Like, who do you want to go out and have a drink with and hang out with because you're about to get into a 5-year partnership with that person or those people. So, find people like and trust, figure out where everybody's skill set is. What I've found in this space especially is that people are very giving. I mean, everybody that I've met is really, they're just giving of their time. They're giving of their resources. They want to help people out. They, at one point, started out as well. And, it's figuring out, hey, what do I want to do? And if you think you can raise some capital, great. If you don't know, right, then maybe you intern on a deal. Say, hey, I want to help you do some of the stuff that you don't want to do so I can learn from the inside and maybe take a little piece of the ownership, but learn, right, and actually do the deals.
That's another really good way. That's how a friend of mine got started. He did underwriting for Michael Blanc and his team in that mastermind, the Dealmakers Mastermind, and that's how he provided value and learned a ton, and then opened up the door for future opportunities. Was literally just sitting in like a dark closet with probably a Darth Vader helmet on, just typing away, like analyzing deals. So that's good. Yeah, man. Just whatever you can do, like build your network, talk to people, like bring value, and intern. I mean, just give your time away for free to get the knowledge to build. And that's kind of how I got started, just knocking on doors and picking up the phone and calling, doing wholesaling like you started out, and then just learning and grew from there by talking to the right people. So super powerful stuff there. So when you guys are raising money, that's where you guys specialize in now, and that's the pivot for 2021 going forward, it sounds like. So what structure are you guys using to raise private money? Is it like 506B funds, 506C funds, or are you guys doing something different?
Yeah, we've done 506Bs historically. We're going to do a C on this next upcoming deal that we're doing this quarter. And then, we're approaching some funds to understand how they structure a little bit better and to see if that might be a good fit.
I guess for the listeners, can you give like the difference of those, like the Reg D, 506C and 506B, and then like how a fund differs from those?
Yeah, so the SEC has exemptions to where you don't need to file something with them. And that's a Regulation D is the exemption. A 506B is the type of exemption, or the 506C is another type of exemption. The B is what they call a friends and family raise. Basically, you need to have a substantive relationship with that person to present them with a deal, right? So you and I just met today. I would not be able to show you a 506B offering.
Oh, come on, man. Come on, show me it.
And we have plenty of those people that are like, no, please, I have money. I want you to take it.
But per the SEC rules, you can't. You got to build a relationship with them. Like, I don't know. There's what was it, that letter somebody wrote to the SEC? It's like, and they responded, the SEC responded. It's like, you got to have the substantive relationship, like know their accreditation. I mean, it's kind of like a 3-step process, like set up a phone call. And if you see, like,
build a relationship with those people,
yeah.
I mean, and the reason that the SEC does this, right? I think people look at the SEC as like the big bad wolf. The reason that they do this is so you just don't take advantage of anybody in terms of an investment idea. You don't know who these people are. Are they sophisticated enough to understand the risks of this type of investment? Now also I believe that the SEC meddles a little bit on who can and who can't make that decision for themselves, but they're really there to protect the consumer. So, I don't go to a retirement community and say, hey, look, I can present you with X returns. Just give me all your retirement funds, right? They've never done
basically the SEC wants to protect people from getting into offerings that they don't know enough about. That's why they have the accredited, non-accredited break. And then in 506C, it's the accredited investors. They have more capital. If they can get, basically they can get into a riskier investment, lose some money in it, not like sink them, to where they're on welfare for the rest of their life because they have enough capital.
Exactly. So the 506B is the friends and family. The 506C, you can publicly advertise for the investment, but you can only take accredited investors, meaning they have to have $1 million of net worth outside of their primary residence or make $200,000 single or $300,000 joint for the last 2 years with the reasonable expectation that they're going to have to do that again this year. So that would be an accredited investor. Most of our investors that have gotten into even our 506B raises are accredited, right? A lot of people don't think they are or don't know that they are until they start looking at their finances, and then they go,
requirements,
look, I am accredited. So the next one will be a 506C, and then to your point, what's the difference between those two exemptions and some of the other ones? There's also a Reg A that has a different type of exemption where you can publicly advertise and still take like smaller amounts of money from non-accredited investors. That's a different type of exemption, but all of these things, this is why you need a good SEC attorney on your team.
Yeah, that's what I was going to get towards. Like, talk to an attorney to find out what would be the best option for you.
Yeah, exactly. And then we have some partners that started Fund of Funds, which is basically a real estate fund that can direct the fund into different real estate offerings from different operators. So we have a couple of partners that do that.
That's good. So, I mean, for those listening, like what's a fund? I think that's a broad term, and then people hear it and might think like mutual fund, whatever. But like in our real estate realm, what does that mean for investors?
Yeah. So, there's different ways to, you can structure a deal so that you can directly invest into a deal, right? The private placement memorandum will go directly into a deal. Or you can create a fund, which is basic. It's what you're thinking about when you think of a fund. You're going to create a bank account and an offering memorandum and say, hey, to invest in my fund, these are the types of deals that we're going to do. These are the type of requirements that we're going to have when we're underwriting deals. And if that sounds good to you, you can invest in my fund. And then me as the fund manager, I can make those decisions on behalf of the investor based on our offering memorandums. Right? So I can say, hey, Blake, this syndication that you're doing, it fits our criteria for what we want to invest in, and we can write you $1 million check out of a $10 million fund, let's say. So, the fund is exactly what you think about. It's just a fund manager has to manage all of those things. And then the investors know what they're getting into more generally than specifically, right? They know generally. Yeah,
it's kind of the difference of like going after like a specific property with those other exemptions rather than having the fund where you can get multiple properties diversified across the properties, which it's neither better or worse. It's just kind of a different way. Maybe the diversification among properties makes it a little bit better. And I know a lot of the big players are using funds. So just, another tool to have in your tool belt if you're thinking about doing this, or, if you're talking to a sponsor and they're raising money in one of these different buckets, it's good for you to, know what's out there and the differences between these things. So,
yeah. And if you're looking for a partnership too, the SEC is kind of hammering down on people right now where you want to be really careful that you're not trading equity for capital, right? It's the SEC does not allow for you to just raise capital into somebody's deal and get equity for it. So you want to make sure that if you're doing that, you can do it through a fund structure, and that makes it legal. Otherwise, you have to be really a partner in the deal. You can't just be trading equity, right? You have to be doing other substantive things within that deal to make sure that your equity position is carved out as a general partner.
Let me see if I got this right. I think we talked about this on the show with Ashton a couple shows ago, but the fund of funds is when you as the fund manager start a fund, and then that fund goes into a deal as a limited partner, and whatever that fund makes, you as the fund manager get a percentage of that. So if the total fund makes 17, okay, let's get the differences then.
I only want to cut you off so that it doesn't confuse the matter, right? Because you can structure a fund however you want, as long as the investor agrees to it. So how Wall Street does it is different than how Ashton does it. It's different than how another one of my buddies does it. It's, so however you function as the fund manager, you can take fees, you can arbitrage the difference of what you're paying the LPs versus what the deal is making. There's a ton of different ways to skin that cat. There is no one set way to create the fund, right?
Yeah.
So
which makes funds good because they're flexible, right? There's so many different ways you can make the best way. So yeah, that's good. I think Ashton's actually like not arbitraging, but going in as the GP rather than taking out of the fund, correct?
Correct. Yep. His is simply a pass-through entity to the LPs, and then they make their money by being the fund manager by partnering with us.
No. Yeah, that's good. Again, another tool to add to the tool belt. So for you guys, like how are you structuring your different deals with the different partners, and how's all that look?
Well, basically we partner with our sponsors on the general partnership side, and we bring in LP equity, right? So a little bit different than having a fund of funds. We are directly involved in the day-to-day operations with our partners too. We're managing the asset management piece of it. We are creating marketing. We're doing due diligence. So we're really involved on a partnership level with all of our sponsors that we work with. So simply put, as our limited partners, they fund a portion of those deals. And then the way that we structure our deals is a little bit different. We do straight preferred returns. So instead of, let's say a preferred return and then an equity kicker, which would mean like you get a percentage of the upside past the cash flow, we basically try to keep consistency at the forefront and lack of volatility at the forefront of our investments for the LP investors. So the money that we put in is at the most risk. The preferred return investors, they get a preferred return, which means they take their money out first before the general partnerships get paid, right? And historically, we've done a 6% preferred return through cash flow with another 6% accruing until the exit. Every investment's different, and they can talk to us directly about kind of how those deals structure, but historically, that's kind of what it looks like.
Yeah. And I like this. This is what we were talking about before we started the show. And I think this is good because it comes back to like investor education and setting the expectations. And, so a lot of deals you see, advertised in like the mid-teens or even higher if it's a really aggressive value add deal. But what happens to those deals when there's a downturn, and these, syndicators have advertised, up here where it's like 18, 20%, whatever. And then they can't hit those returns, so that investors that are used to 18 or 20 are now getting, 15, 12, whatever it looks like. And like, man,
it's scary for me.
I'm losing money. Yeah.
Yeah. I mean, and we talked about this internally about this is why we're going to structure our deals this way, is because, the name of our company is Integrity Holdings Group, right? Based on Proverbs 9:10, which states that the man with integrity will walk securely. The man who does not will be found out. And it's just to hold ourselves accountable to that structure. If I'm promising 18, I want to make sure that we're giving away 18. If we're promising 12, I want to make sure that we're giving away 12. I think that for the accountability for ourselves internally, I don't want to just shoot the moon, and then if we fall on our face, go back and say, whoops, right? So by structuring our deals this way, it creates the consistency that we were hoping for, the volatility hedge that we were hoping for, and also the accountability that we hold ourselves to.
Yeah. I love that, how that verse is tied into the company name, is tied into the actions, it's tied into, how you guys go about everything, kind of aligning it all there. So that's really good. So can you talk about like how you educate investors to say that, hey, this is low volatility, this is, your preferred return, how you go about raising money, kind of?
Yeah. I mean, it's tough because we can't just stop everybody on the street and say, hey, have you heard of real estate? Mm-hmm. So, the first thing is trying to get in front of the right people. Who is looking for real estate investment? Why are they looking for that? And then spending time with them. We have to get to know every single one of our investors, whether it's a 506B or C, by the way, I don't care. For anybody to give you a check for $100, $200, $1 million, they need to know, like, and trust you. They need to understand who the business is, who are the partners, how did you guys get here, and what makes them comfortable with the operator. So how we educate is a couple different ways. We have the podcast where we're talking, about what's going on to our audience, whether that's about deals that we just did, whether that's how, we blew it and we learned, whether that is how we invested our children into some of these deals. I mean, all of that stuff, we talk about it all, right? We're very much an open book on the podcast.
Yeah.
And then on our website, we have a couple of things that you can do. You can sign up for our investor club, right? Which gives you access to our newsletter, where we're giving you a lot of news articles and kind of historical facts and things like that, and kind of telling you what's going on in the business. And then we do a passive real estate investment course. We do a training course that you can sign up for free. It kind of walks you through the steps of what do I need to do? What should I be looking for when I'm getting involved in an investment? So all those different ways, really. And then once people sign up and they get involved, and they have to schedule a 30-minute call with me to have that conversation about what their investing goals are. Can we help them achieve those investing goals? Or is this a good fit for them or not? What's their level of sophistication or accreditation? So education is the crux. I mean, we want to teach everything that we've learned to people that are coming this way with us, right? I mean, how did we learn it? Why did we learn it? What did we read? I just sent out 3 books to one of our investors yesterday because she called me and had a bunch of tax questions. I said, oh, these 3 books are fantastic for you. And she was like, oh, you've already sent them? Yeah, read through them. And then, go talk to your CPA about what you just learned. And it's just educating yourself. I mean, you have to be in charge of your finances, right? You're going to take control of your financial future. You can't lay that on anybody else. So it's those,
so much more powerful than
seeking knowledge.
Yeah, so much more powerful than letting it sit in a mutual fund for the next 30 years. It's really good.
Yeah.
Yeah. Yeah, we were talking about that. And what you're just saying too, like kind of on that topic, like Blackstone, like the biggest, real estate, conglomerate, really raised $8.7 billion last year. And it's just because of the best known, and their total return was like 5%. What was it? 5.3. I mean, you said the number before we got started on here. But to raise that amount of money and produce that kind of return in this space where we're, told that you can, beat the market, be more secure and all that. I mean, they're like returning at the market level. They're not even really beating it. I mean, what does that mean for you and your ability to go find investors and actually allow them to get returns that can produce financial freedom and can produce real results?
Yeah. I mean, Blackstone's aggregate returns are very solid. I understand why people invest with them, and why we even named the podcast Free from Wall Street is that I think most of us have an idea of how Wall Street makes their money, right? They take your money, pay you a solid return, or what you've been pitched on as a solid return, and then they take the rest. And what we get to do is cut out the middleman when people directly invest with us. It's a harder conversation. It's a longer conversation. It's more education. It's more relationship.
Yeah, that's what people have known forever is like put your money into Wall Street. So like to teach unconventional wisdom is the battle, is the uphill battle. Yeah, that's good. Yeah, I wish we could just get more money off of Wall Street. It's just. I
mean, I think it's happening. I think that the CARES Act allowed for a lot of $100,000 withdrawals penalty free, and we had a ton of investors pull out of their 401k and invest with us through the CARES Act. And I think people are understanding that we're coming to the top of the market, and you're probably going to see some volatility in the stock market every time there's a changing of a presidential guard. Then you'll see that. Also, it's been a bull market for a couple of years, so. What goes up must come down.
Yep. Yeah, that's a good point.
I think people are starting to recognize that they need to hedge against some volatility. And the more conversations that we have with them, and the more that they listen to shows like this, the more that they recognize that it's an option. I find that that's the biggest hurdle. Actually, is not that people don't want to invest in Wall Street; it's that they don't know anything better. They haven't been exposed to these types of deals or these types of operators or these types of opportunities, because they think that that's the only way that they can go ahead and do it, and nothing makes me happier than when I see somebody that is invested with us and, they're just grinning ear to ear. I get pictures of, our investors getting their checks, and they're like, I got my check this month. Meanwhile, the economy is doing pretty poorly, right? They got their monthly checks though. And, but they didn't know it before we started talking. When people ask me what I do, and I tell them that we pair passive investors with high return real estate assets, they don't understand what that means initially. Not everybody does. And then they start to learn that that's an opportunity.
Yeah. Hopefully that's good and opens up that door for the conversation. Like, hey, here's what I actually do. And here's how it could, benefit you or someone, or, whatever, however many ways that conversation can go. That's good stuff.
Fortune 5.
Cool, man. Well, or for you, for the rest of 2021, what do you think's in store for you guys to keep growing?
So, we're very much focused on the education aspect of the business. We're creating a lot of content to get out to, larger and wider audiences. We have the deal flow. Like I said, we're going to be raising about $15 million here in the first quarter. So that's kind of where we'd like to land at the end of the year. We'd like to raise and deploy somewhere between 50 and 70 million bucks. And it's a big number, but we have good deals for those numbers. And I think some people might hear those numbers and get intimidated, like, oh, I'm probably too small of an investor. You're not. We just still have to have the conversation and figure out exactly what deal fits for what person and what their tolerance level is, right? We have my daughter is our smallest investor. She's 7 and she's got $13,500 with us. She's the smallest investor.
I love it. Are you paying her out of the business with like the $12,000 or whatever that you can deduct from taxes?
She's a limited partner in the deal. She gets monthly checks like everybody else.
Nice. And is that going into like a Roth IRA that's building over time?
Here's her last one.
I love it. He just held up a check.
It's for $201 for her $13,000 investment. By the time she's 10 years old, her $13,000 will be $20,000, and then she'll just continue to roll that into more investments. And if you go to our YouTube channel, we have a video called Millionaire Kids, and we actually do the compound interest calculation with her and figure out what day she'll become a millionaire.
I love it. I really like the strategies like that because me and my wife are like beginning to talk about when we're going to have kids in the coming years. I think she wants them like by yesterday. But it's thinking about this or like how like who was it? Brandon Turner like bought a fourplex or whatever it was for his daughter and let that grow over time when she was born or like when his wife was still pregnant. But yeah, like setting your kids up on that path. And then as they're growing up, you get to have the conversation with them and so many good opportunities there and they're making money the whole time. So that's really cool. I like that.
Yeah. They're learning how to be good stewards of money, right? I mean, it's, I think we do a disservice to our kids that all of a sudden we release them to college and let them go when they're 18 and figure things out. My daughter understands that she has an investment and 10% goes to a tithe. And 50% of the remainder goes to savings, and the other 50% she can spend or save if she likes. Right? So,
heck yeah,
turning
kids into passive
really
investors.
Yeah, absolutely.
I think if your 7-year-old daughter can be a passive investor, so can all the people listening to this podcast. So that's awesome.
Look, if my 7-year-old has a better real estate portfolio than you do, you should get on the horse. Right?
Yeah, no kidding. Give one of us a call and see what the heck you can do. That's crazy. You got a 7-year-old out earning you in the multifamily game. I like that. All right, awesome, man. Well, let's transition to the last section of the show here. This is the Fortune 5, the 5 questions I ask every guest at the end of the show here. So kicking it off, what's the biggest thing that has contributed to your success?
Mentorship, for sure. It's other people. We all have desire to win, I think. And, until you put that desire into action, it's worthless. So it's really about getting around the right people. And those people have helped change our lives.
So good, man. I think at one point I'm going to compile all the data from these questions and make like a post or a video about it or whatever. But I've heard that one a few times. It's like getting around the right people, mentorship, finding a person to kind of guide you as you get started. And, if that's a common attribute to successful people, and if that's like their biggest successful thing, like if you're listening to this right now, I mean, it just emphasizes go get around the right people. So that's a really good answer. I like that. Next question here. What's been your biggest mistake so far that's turned into a learning lesson?
I would say, we're very trusting people. So the biggest mistake earlier on in our career was to trust but not verify. Mm-hmm. Right. So now we say it all the time: trust but verify. Right. When people tell you numbers, great, show me them. right? People talk to you about returns. Great. How many exits have you had that show those types of returns? People tell you that they can manage something to a certain budget and a certain timeline. Great. When was the last time you did that, and who was the operator you did it for, so I can talk to them? So without getting into all the hairy details, it's trusting and not verifying.
Yeah, that's good. Yeah, I love the transparency of this question, and I've been burned by that too. Just like putting my trust in somebody without saying, "All right, show me what's behind that." So that's good. Well, what's been your biggest? What's your favorite book you'd recommend to someone starting out?
Well, it's kind of a big question. Favorite book to somebody starting out in real estate, I would say read Tax-Free Wealth by Tom Wheelwright to understand, the tax implications that you get when you start investing in multifamily. Because making money is great, keeping it's better, and Tax-Free Wealth is a great resource. Starting out in life, spiritual journey, things like that, I would say read the Bible. There's more long-term, eternal truths written in there for both business and relationship than you can find in probably any other book. Ton of wisdom there. So,
yeah, I like that too. Answers. I actually got Wealth, or was it Wealth Free Real Estate or Tax? Whatever that book is, but Tax-Free Wealth. I got it mixed around. Yeah, that's actually on my list. Wealth Free Real Estate. That's not what I want. I want very well.
No, it's the opposite.
Yeah. So, man, Steve, last question here. Where can people find out more about you and connect with you?
Yeah, you can just go to our website. The name of the company is Integrity Holdings Group. So the name of the website is Integrity HG. You can sign up for our courses there. You can find out more about our deals there. You can also check us out when we talk about invest with purpose. That's kind of our tagline. And in every single deal that we do, we give a portion of the equity ownership to a nonprofit, 501c3, so that we create passive income for those nonprofits too. So we're digging wells in West Africa. We're saving girls from sex trafficking in the Middle East. We're building handicapped accessible parks here in New Jersey. So if you want to learn more about how we can make an impact in those investments too, you can find the Invest with Purpose tab on the Integrity HG website and kind of talk to you a little bit about how us and our investors are collectively making an impact through creating some wealth.
All right, man, that's awesome. That's super good, man. Thanks again for coming on the show here today. Really good information. I think for anybody starting out, there's a lot of good information here. And Steve, this was good, man. I appreciate it.
Yeah, thanks so much for having me. Appreciate it.
Yep. All right, we're out of here.
Hey, thanks for listening. If you like the show, if you found value in it, please go to iTunes and leave a rating and review. And if you want to check out more on your multifamily journey, go to multifamilyjourney.com, where you can get free resources to start your journey and figure out your path. That's multifamilyjourney.com. But more importantly, go take action today towards your financial future. See you next time.